Welcome to a video that I like to call the deep dive video. Don't let the name mislead you. I use this in a little bit different context. Every week I do numerous videos. I do daily videos, I do a weekly video, I do an intermarket analysis video. I also do a condensed video which just breaks down each day's action. When I finish doing all of the videos for the week, I look through all of the charts, I go back and I pick out those charts that I really didn't talk about in any of the videos over the past week. I decided to put together this video because sometimes we can still gain some insight about what is going on in the market. This is being prepared for Monday, July 31st. The first chart is the VIX and then a 3-month average of the VIX, and we take a ratio of that. We can see that the black lines are declining overall, suggesting that fear is really coming out of the market. I also plot a moving average on here, which is also declining, suggesting that there's not a lot of fear. Since we really haven't changed in this chart all that much, I haven't decided to use it. I have another chart of the VIX where I plot an RSI 9 period where I'm looking for extreme positive or negative readings. We're just about in the middle now, so I've decided not to use that. I also look at the VIX and then take a ratio of the VIX, which is the volatility of the VIX. We do a ratio of that, and what I look at mostly is the blue line going down below. That is a moving average suggesting that fear is tending to decrease. If you go back and look, right when we bottomed in the S&P 500, this is when we topped in this ratio, and since we've been coming down, the S&P has been going up. This is a longer term chart, so I don't use it as often. Now, typically when you look at the VIX, it has static numbers, 12 to the downside, 20 to the upside. When we go above 20, it's considered that fear is excessive and we're looking for some kind of a bottom. When we drop below about 12 to 12.5, it suggests that there's a lot of complacency and we may be near a top. Well, the VIX doesn't always act around those static numbers. So what I do is I plot a VIX on this chart and then turn it invisible, and I have a 50-period exponential moving average, and over a long period of time, it can give us a more dynamic range. From 2008 to 2011, we were in a range of about 40 down to 20. Then from 2012 up until the COVID crash, we dropped down to a lower range. Then after the crash, we went back up to a higher range. We're starting to fall below 20 now, and we're starting to wonder, will this establish a new lower range? We don't know that yet. We just keep an eye on this chart. We also look at the VIX index and compare it to the MOVE index, which measures volatility of bonds. It has been decreasing overall, suggesting there's not a lot of fear in either the bond market or the stock market right now, even though the bond market took some hits this past week. Then we look at the SKEW index. The VIX measures at the money options to gain its insight into volatility. The SKEW index looks at out of the money options. And when this is really going up, the market is expecting some kind of a big move. When we get into this red area and then top out and come down, something typically will happen. Sometimes it's been a continuation of the trend. Sometimes it's marked a top. Other times it's marked a bottom. We have to look at other charts to gain the actual context. And then just for comparison purposes, I also track the VIX down below. It's always interesting to find out how far away are we from the all-time high. I base this on the intraday high set on January 4th, 2022. We're now down 4.91% from that all-time intraday high. We also have a thing called technical alerts. This is put out by stockcharts.com, and you don't have to be a member to use this. Every day they have a series of predefined alerts that are triggered, where the first signal that was triggered came from Canada, actually. It was a bearish 50-20 week moving average crossover. Since the 50 moved below the 200, that's negative, so it's red. You can go and look at these. They have them for every day. The ones I'm just showing you right now are only for Friday because the list can become very, very long. We also like to look at the different indexes. We look at the S&P 500 index in the program that I offer. We also want to keep an eye on other indexes. We look at the Dow, we look at the mid caps, the small caps, and the QQQs, which is the Nasdaq 100, and then we can rate them on a score of 0 to 100. The higher the score, the better looking the technical chart. This is also put up by stockcharts.com, and it's an objective way of measuring how does the chart look. First place this week has been in first place for a while now are the QQQs, which is the Nasdaq 100. It's coming in at 98. The closer we get to 100, the stronger the chart is looking. In second place is the S&P 500 at 88.2. It's also been showing a lot of strength. There's a lot of Nasdaq 100 stocks that make up the S&P 500. In third place are the small caps. We've been seeing a lot of strength in the small caps, coming in at 63.9. In fourth place is the Dow, right behind it at 62.8. And then in last place, which is a little bit surprising, are the mid caps. They've been showing a little more strength throughout the year. Now they're showing some weakness, coming in at 61.2. Then we look at some short-term charts. This is a short-term moving average rainbow going from 10 periods up to 50 periods. We're above all of the moving averages in this rainbow, and all of the moving averages are flowing up nicely, suggesting a good solid short-term trend. We also look at the 20-period simple and exponential moving average. I do show this sometimes. We're well above it right now, so I haven't been including it. There has been some times in June and July when we came down and this acted as support. We're well above it right now. If we see a decline, we'll be watching this moving average. We also have a moving average tree, and we're well above all of the plotted moving averages, so I haven't been showing that. I also take a 20-period simple moving average of the open, high, low, and close. Sometimes this will act as support if we start to fall. Other times it will act as resistance if we're in a downtrend and start to go back up. We're well above all of these moving averages now, so there's been no need to show it. I also have a thing called the boom indicator. This is based on a 20-period moving average, a 50-period moving average, and a 200-day moving average. How far away does price get away from that moving average? The moving average tends to act like a magnet, or if price gets away, it's like a rubber band. If it gets too far away, it has a tendency to come back. Well, we can measure that using this chart. We're not extreme right now in the 20, 50, or 200. The fact that we're positive and near the top for both the 20 and 50 does suggest that things are positive, and when we're above zero with the 200-period moving average study, that suggests that in the longer term we're also positive. Looking at fundamentals, up on top is the S&P 500. We have the earnings that are being reported right now, but it takes a while for this chart to update. The higher the S&P goes, and if the earnings don't change, the higher the PE ratio goes, and that's starting to go up. We're getting at 26.16 now. As the PE ratio goes up, the dividend yield tends to go down, and we're currently at 1.50. Intermediate term charts, we have the Connors RSI, which is very similar to a regular RSI. We use this like an oscillator, extreme positive or negative readings. If we're above the dashed line, that's positive. Below the dashed line, that's negative. Then we have the 50-period moving average, and we're well away from that, so there's no need to show it. The same thing is true with the 100-period moving average. The intermediate term rainbow chart goes from 50 periods up to 100 periods. We're well above all of the moving averages, and all of them are smooth and going higher, suggesting a strong intermediate term trend. Then we also have an anchored moving average going back to the all-time high. We're well above that, so I haven't been showing this chart. Then we can also see, are we above or below the 200-day simple moving average? When it's green, we're above, and this is also suggesting that things are positive. We also have the mass index. It's not generating a signal right now. We only get excited about this when it goes up to the red dashed line or to the blue line. Since it's far away, I haven't been showing that. Then this is a trend channel going back to the lows that we set in June and October of 2022. And I drew a trend line going from this low to that low. Then I drew a parallel line going from the all-time high and then stretching down. For a while, this acted as overhead resistance, but we've been able to break through that. And since we're far away from this upper trend channel line, I haven't been showing this chart. Then we have the Ichimoku cloud. When we're above it and falling, that can act as support. When we're below it and going back up, that can act as resistance. We're far away from the cloud right now, so I haven't been using that chart. Really, all this are some moving averages that are then shifted forward to give different support and resistance levels. We have the CMB Composite Index, which is supposed to be a short-term standalone trading system. I use this more like an oscillator. We did get extreme positive here for a while, but now we've been dropping off. So I haven't been showing this chart in the videos. Then we have Bollinger Bands, a very useful tool. When we're above the midpoint and near the upper Bollinger Band, that is more positive. When I really take notice is when we go outside of the Bollinger Bands, and currently we're not outside of those bands. That's measured by a thing called the percent B indicator. When we get above this one area, that means we're extreme positive. When we drop below it, then we're extreme negative. We're not giving an extreme reading right now, so I haven't been including this chart. Then we have the point and figure chart. Nothing new was drawn this past week. It's still looking positive. The last signal that was generated on this chart was on May 18th, which was a double top breakout. Then some long-term charts. This is a long-term rainbow going from 50 periods up to 250 periods. also showing that the longer term trend is positive and we're far away, so I haven't been including this chart. Then we look at some Fibonacci retracement levels, and we're far above them. We're also far above this longer term moving average. Since we are far away from that, I haven't been including this chart. Then we look at a weekly chart of the S&P 500 on top and a weekly chart of the German DAX index on the bottom. Sometimes these tend to correlate really well. They haven't been correlating all that much lately, so I haven't included this chart. Some support and resistance levels. We have the quadrant lines. All I did is go from the COVID bottom to the all-time high, and this just breaks it down into 25% chunks. We broke above the 75% level. We're also trying to get above some resistance here, but really the next level that we would be concerned with would be the 100% retracement. The Fibonacci charts that I typically use, they're not really useful right now because we've had beyond 100% retracement on our short-term fib chart. We're in no man's land with our longer-term fib chart. And then this is even longer term where we're also in no man's land, and this has a number of different Fibonacci levels that overlap each other. We also are keeping an eye on the Nasdaq 100 Fibonacci level. We're well above the 61.8% retracement level. We're not up to the 100% retracement level yet, so we're in no man's land here. We're also keeping an eye on the financial sector. Way back in 2007, it set a high and then we dropped. We came back up to this level in 2020. That acted as resistance. Then we had the COVID plunge. In 2021, we were able to break through this. Well, now the financial sector's come under some difficult times. What once was resistance now becomes support. And so far, this level has been holding. We're far away from that for right now, so I haven't been including this chart. Looking at some broad market indicators. This is the Vixen, which is the VIX for the Nasdaq 100, also showing that fear is really decreasing. Then we look at the S&P 100 and compare it with the S&P 500. Earlier in the spring, the S&P 100 was outperforming the S&P 500. We're kind of seeing a reverse of that right now. Lately, the S&P 100 has come under a little bit of pressure where the S&P 500 has been outperforming. But now they're moving more in lockstep with each other, so I haven't been including this chart. We also keep an eye on the microcap index. We came down below 100. We set a new 52-week low, but then we've been able to bounce up off of that, and we're getting back to the point where we're almost seeing a golden cross with the 50-period moving average going above the 200-period moving average. We also keep an eye on a weekly chart of the Qs going back to the all-time high. We're well above this anchored moving average, so I haven't been showing this chart. We also keep an eye on the QQQs, which is the Nasdaq 100 and the ratio to the Dow, and then compare it to the S&P on top, where the Qs have really been outperforming the Dow. And sometimes they'll have a real strong correlation, meaning that they're going in the same direction at the same time. But lately, we've dropped down to a neutral relationship. Some rate of change charts, these are very long term. Going back 250 periods, we are seeing a little bit of longer term weakness on this chart. This goes back to 1980, also showing a little bit of weakness. Looking at bonds, we keep an eye on the yield curves, and those yield curves that are inverted, all of the yield curves that I follow are currently still inverted. Then we look at the US 10-year yield, and we subtract the German 10-year yield, and that gives us a line up here with some support and resistance on it. And it's amazing that sometimes it correlates very strongly to the US dollar index. That relationship has been dropping off lately, but sometimes this relationship is pretty strong. We're also keeping an eye on TIPS. These are shorter term Treasury inflation protected securities. These are what people use when they're uncertain about interest rates, and so they buy these shorter term maturities. You can roll it over into the next maturity, giving you a higher interest rate. When we're more convinced that interest rates are not going to go up, people get out of TIPS and they get into longer range bonds. And when we look at this ratio between the shorter term TIPS and the longer term bonds, it has been in a downtrend with this overall ratio, but now it's starting to come back, and we could see a golden cross in this ratio as there may be some inflation worries coming back into the market. Then we look at the S&P 500 and then the long-term bond ETF. The longer-term relationship, they have a tendency to go in the same direction. It really weakened earlier in the year. It was showing some improvement, but now it's rolling over. The shorter-term relationship is also showing that they're going in opposite directions, and the spread between the two continues to get wider. I have a number of things called possible positive scenarios. This is usually when we're going down and we see a washout crash or at least some kind of a bottom. And when these things all come together, They're possible in that we don't know for sure if they're going to happen. They're positive, thinking that the market would go up, and then we take all of these together to create a scenario. The first one is the number of stocks in the S&P 500 that are above their 50-period moving average. We use this like an oscillator, either extreme positive or negative. Well, we're not that way right now, so we don't really use this chart. We do the same thing with the mid caps, and we also have another index with the small caps. Then we take a longer range look at the percent of stocks in the S&P above their 200-day moving average. Again, when we're above 50 and going up, that's more positive. When we're below 50 and declining, that's more negative. We can also use this like an oscillator, and since we're not getting an extreme reading right now, I haven't been using this chart. Another chart that's really been kind of frustrating is sometimes when the 2-year Treasury yield really goes up and then starts to come down, that can give some short to intermediate term support to the S&P 500. Unfortunately, until about a week ago, they were going in the same general direction. Lately, we've seen them going in the opposite direction. Now they're working more back to a neutral relationship, so this chart really hasn't been all that helpful. Another possible positive scenario is when we hit a bottom based on price or volume. This is a 19-day exponential moving average of the advanced decline ratio. When we see a real extreme negative reading and it's confirmed on both price and volume, that can be helpful. Sometimes this can also give us clues about a top, although we haven't seen a signal generated lately. We can say that this is tending to be more positive since both based on price and volume are above zero. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a really good weekend, and I will talk to you in the next video.